Good morning, everyone. Um, we are now going to start the next chapter in our syllabus, which is chapter 13, which is the statement of cash flows. So what I want to begin with now, when we talk about the statement of cash flows, I want you to realize that it's different from any other financial statement that you have reviewed, okay? What the statement of cash flows is going to do is that it's going to test your knowledge of accounting up to today. All right. The statement of cash flows. Okay, first off, all right, just so that you can get a sense of what's going on here. The statement of cash flows is the only financial statement which is prepared on a cash basis. Okay, now why is this financial statement prepared on a cash basis? All of the other financial statements are on an accrual basis. Okay, and it basically comes down to, that if you have a check in your account, okay, in your bank account, and that check has not yet cleared, all right, and then you write a check which basically draws down on that amount that's in your bank account that has not yet cleared, you know that check is going to bounce. In other words, you know they're not available funds, okay? And that's why this statement is so important, all right? It's not enough for a corporation to have revenues. It's not enough for a corporation just to have net income. A corporation must also be liquid and have cash available, okay? You can't pay a liability off with an account receivable, okay, or a note receivable. It actually has to be cash. Okay, in addition, a corporation has to know where their cash is coming from. Okay, now in the beginning, when a corporation first forms, you know that typically the corporation is getting its funds from selling stock. Okay, that's usually the first transaction in the life of a corporation, that the corporation is going to issue stock to its shareholders. Okay, so issuing stock is typically going to be the first transaction that's going to happen, okay, in the life of a corporation. Okay, and another source of financing a corporation can have after issuing stock, after it's been conducting business for a while, a corporation can also issue debt. Okay, and that's bonds payable, something that we dealt with in chapter 10. All right, but realize that a corporation has to eventually start showing that it has earnings. Okay, it has to start generating its own income in order to generate its operations. Okay, a corporation cannot stay in business off of financing. Why? Because after a certain period of time, investors are not going to want to invest in it. Okay, they want to know that the corporation basically is able to survive on its own. Okay, so that's why, again, as I touched on last class, when you think of the statement of cash flows, okay, immediately what's going to come to mind is the fact that there are 3 sections in the statement of cash flows. Okay, and again, you are going to remember OIF, okay, a little mnemonic. All right, and OIF basically stands for operating, okay, which is the first section, operating in the statement of cash flows. And again, these sections must appear in this order. First, you have the operating section. Then after the operating section, you have the investing section. Okay, and then after the investing section, the last section, which always appears, is the financing section. Okay, so a proper statement of cash flows must always include these 3 sections. And what it's going to do, and what we're going to spend this class and probably a lot of the next class talking about, is how the information is going to be generated. Okay, now, so first of all right, for our class, again, this is one of the partial chapters. All right, you do not have to read the whole chapter, but the part that you are responsible for is the direct method. Okay, you are responsible for the direct method of preparing the statement of cash flows. There's a second method also that's in this chapter, which is the indirect method. You are not responsible for that. Okay, now for this chapter, okay, when you feel overwhelmed, when you get a little sidetracked, what you always have to say to yourself is, okay, I'm dealing only with cash here. Okay, it's cash, it's the effects of cash on the corporation. Okay, different from any other financial statement. Okay, and actually, just to give you a heads up, what we're going to be doing this chapter, is basically this chapter is going to test your knowledge of accounting, because what we're going to be doing in this chapter, specifically when we're looking at the operating section, okay, we are going to be reversing all the accruals and deferrals. Okay, all the accruals and deferrals, remember in chapter 4 when you learned all about them, all the accruals and the deferrals in accounts are going to be reversed. Okay, and there's a very certain logical order. In the beginning, you're going to think, wait a minute, where is this coming from? This information is so different. But once you do a statement of cash flows, you're going to see that it gets very repetitive. It's always really prepared in the same way. Okay, so it's very different in the beginning, but after the first time, you'll get to be pros on it. Okay, remember also that the statement of cash flows is a required financial statement. Okay, according to GAAP. Okay, it must be included in the financial package. Okay, that is audited by the CPA firms, and also that is presented to the SEC and the outside investors also. All right. Okay, so let's go through this process. Let's see what we're talking about here. I'm going to go slowly, okay, and remember that. Okay, just to give you a last stage of the overview. In each of these sections, okay, as we're going through the transactions for the operating section, the investing section, and the financing section, okay, within each of those three sections, you're always going to have basically a subtotal for all the sources of cash. Okay, and then you're going to compare it to the uses of cash. Okay, oops, within each of those three sections. Okay, the sources of cash and the uses of cash. All right, so that is the format. All right, and again, we will be having a quiz on this in, I'd say, like 2 weeks. Okay, all right, so let's move forward. Again, when we're talking about the statement of cash flows, it's such an important statement because a business cannot stay in operations unless it has sufficient cash available to fund its operations. Okay, again, what is the cash going to be used for? Again, if we're using an example like PepsiCo, basically it could be used for capital spending. Okay, making major purchases that the corporation needs for completing its business cycle. Again, it might be buying a new bottling plant for a company like Pepsi. Again, remember when we're talking about bonds payable, remember bonds payable must be repaid upon maturity. Okay, again, a corporation has to know that it has sufficient cash available if they must pay back the principal, okay, on an outstanding debt. Okay, we know, especially recently, if you look in the stock market and you see what's going on, you know a lot of corporations like Amazon, Apple, etc. They buy back large portions of their existing common stock. They buy it back from the market. Okay, typically because they're going to use it for employee stock option plans, or to temporarily boost their earnings. Okay, so again, if the corporation wants to buy back some of their common stock, they need sufficient cash to be able to do that. And again, of course, the corporation has to have enough cash if they are going to pay dividends to their shareholders. Okay, and this is all aside from the fact that they have to also be able to fund their day-to-day operations, right? They still have to pay their employees. They still have to pay off their obligations to suppliers, etc. Okay, so cash is king. Cash is such an important vehicle or asset for a corporation. A separate financial statement is prepared, just detailing the transactions here. Okay, now again, what's the objective of the statement of cash flows? It's going to provide information, again, about the cash receipts and cash payments of a business entity. Not accrual accounting, the actual cash that's being received and being paid. Okay, in the statement of cash flows, you're not going to hear it enough. These are the three sections. Okay, operating, investing, and financing. Okay, and again, they must appear in that order. All right. Okay, the benefits, some more benefits of the statement of cash flows. Again, the most important section, okay, and a good piece of information, the most important section over the long run, okay, is the operating section. Okay. You're going to see very shortly that when we're looking at the operating section of the statement of cash flows, the operating section basically summarizes the results of operations. Summarizes results of operations, including the revenues and the expenses, related to continuing operations. Okay, so we're going to spend the bulk of the time when we're talking about the statement of cash flows, we're going to spend the bulk of the time talking about the operating section. That's the first section that we're going to review, okay, and that's the hardest section. Okay, so don't be overwhelmed. Okay, we have two other sections, the investing section and the financing section. They're much easier. Okay, but the operating section, again, over the long run, okay, especially if you're a potential creditor of this business, if you're a potential investor in this business, it's most important, okay, that you see that over the long run, it's important that you see cash being generated in the operating section. Okay, again, you have the investing section. A corporation, if it's a manufacturer, okay, let's say it's a manufacturer of shoes. Okay, a business cannot stay liquid as continue its operations if it's selling off the assets. Okay, and that's really what the investing section looks at. Okay, really the buying and the selling of investments, either stock investments, bond investments, or plant, property, and equipment. Okay, can't really stay in business over the long haul doing that. Okay, a corporation just basically selling off your assets for cash. And again, the last section that we're going to look at, the financing section, after a certain period of time, again, corporation can't just rely on financing from outside sources. They have to be generating earnings from the actual underlying business. Okay, so the operating section is the most important section. Okay, again, once a business has been operating for a while, that's where investors and creditors want to see the majority of cash being generated. Okay. Again, why do we care? Cash is king. Okay, the company's ability to generate positive cash flows, that's what you're looking at. You want to make sure that that's what's happening. Okay, if you're looking at a potential investment, or you're looking to buy bonds in a company, are they going to be able to generate profits? Okay, can this company pay off any debts that it has and also pay any dividends? Okay, that the investors are going to require. Okay, another thing, a very important thing that is highlighted, okay, by the statement of cash flows is a company's need for external financing. Okay, a corporation can't wait until there's no cash in the bank. Okay, and at that time they're going to start issuing stock. Okay, or issuing debt. They have to know, basically, they have to be able to prepare, okay, when in instances like this come up. Okay, so the statement of cash flows is going to help the corporation determine what their long-term and short-term financing needs are. Okay, and remember, a very important component here is net income does not equal the amount of cash generated, right? If we look at the income statement, okay, we know that if we look at the last line of the income statement, we see, okay, very nice, the corporation has generated a nice profit, okay, for this particular year. But, okay, has the corporation actually received, okay, the cash that is due from their accounts receivable? Okay, have their notes receivable when people outside parties owe them money, have those outside parties submitted that money, okay, for collections to the corporation? Net income is not cash. It's not enough to generate net income. You have to have enough cash to fund your operations. Okay, and again, we're going to see in a little while, they're cash and as well as non-cash, okay, transactions which occur in a corporation's life. Again, all this type of information must be disclosed to the shareholders. Okay, so what are we going to be able to do once we complete, okay, the full statement of cash flows? Okay, what are we going to be able to determine? Okay, once the statement of cash flows is completed, investors and creditors will be able to determine, okay, where the change in cash position, be able to determine where the change in cash position this year came from. Okay, so investors and creditors will be able to tell, okay, where the change in cash position for this corporation came from. Okay, are they generating enough cash from their operations? Is it from their investments that they're actually generating the majority of their income? Or is it coming from outside financing? Okay, so if I ask you, cough, cough, on an exam, maybe on a quiz, over the long run, which section is it most important that a corporation is generating cash in? What would your answer be? Which section is it most important that over the long run, the corporation is generating cash? Continuing operations. Very good, Joshua. Very good, Casey and Jason Lysander. Excellent. Okay. Okay. Oh, just to take a step back for a moment, when just look at our investment. Okay. Remember, we purchased one share of Phantom stock. Apple stock was trading at $115.48. Today, when I checked right before class started, one share of our Apple stock was trading for $116.93. Okay, so again, it increased. The market price increased a little bit since we last got together on Tuesday. But again, the stock market has been volatile, okay, as you know, since this semester began, or actually since last semester. But what's been happening is that they're not sure, okay, the investing public is not sure if the government is basically going to provide some type of stimulus package, okay, because of COVID. All right, so again, Steve Mnuchin, who's the director of Treasury, has been indicating that yes, they are going to. Then on the other hand, they're saying no, they're not going to. Again, this is information you need to be aware of. Okay, so please, again, follow the stock market. Okay, follow financial news. It's going to be to your benefit. Okay, one day we are all going to be past COVID. Okay, and you really have to prepare yourself for what it's going to look like at that point. Okay, so please stay alert. You're stuck home anyway, right? So why don't you take a few minutes, a little less TikTok, a little less Facebook, okay, and just take a look at what's happening in the markets, what's going on, okay? Even just the headlines, okay? It'll give you a good indication. All right. Okay. So now buckle up, guys. We're going to move forward from here. All right, so we are now talking about the first section of the statement of cash flows, which is the operating section, okay? The operating section, again, basically is the section of the statement of cash flows that looks at the cash effect of the transactions that are based on the continuing operations of the firm. Okay, so when we're looking at, I know I mentioned all three sections. Now we're going to be focusing on the operating section first. Okay, so what are we looking at? When we're looking at the statement of cash flows from operating activities, okay, again, we're always looking at sources of cash, okay, within each section, and we're comparing it to the uses of cash. Okay, within each section. So it's receipts or payments, sources or uses, they're interchangeable. All right. So what are some of the sources of cash from operations? Of course, collections from customers for sales. Okay, so a source of cash is the sales revenues. Okay, or the sales dollars. That's the biggest one typically for a large publicly traded for-profit corporation. Okay, we saw that also corporations typically invest in, at least in the short term, in other investments in the stock and the bonds of other companies, okay, if they have idle cash. Okay, so another source of cash in the operating section would be interest and dividends received. Okay, and then again, the last thing, okay, if a corporation, again, it could be unusual circumstances. Remember, we talked about unusual and infrequent circumstances, like the settlement of a lawsuit, okay, things of that nature, which is positive, which is settled in their favor. Again, there could be other receipts from operations, such as a settlement for a lawsuit, maybe patent infringement, copyright infringement, whatever it may be. Okay. So those are the three typical sources of cash in the operating section. Okay. Now, what are the typical uses of cash in the operating section? Okay, the first is payments to suppliers and payments to suppliers of merchandise and payments to employees. Okay, one of the biggest, okay, so what are we talking about cash payments? Here, if it's a retailer, if it's a wholesaler, what are some of the biggest purchases, okay, that are corporations like that are going to make? Basically inventory purchases. Okay. All right, so we're going to have to figure out, okay, what is the amount that a corporation pays for inventory purchases? Okay, that's a major outflow of cash. All right, and I'm going to show you a formula in the future. A lot of these, okay, when we're looking at the statement of cash flows, really a lot of these different sources and uses of cash have to follow a certain formula. Okay, and I'll show you. It's not like, it's not an intense formula. It's a very logical formula. But again, it's going to test what your knowledge of accounting is up until this point. Okay, so again, inventory purchases, that's a huge use of cash for a business. Also, salaries to employees. Okay, all of these very important payments. Okay, by a corporation. Okay, but remember, when we're looking at all of these cash payments, we can't just look at we have to be able to reverse the accruals that relate to these transactions. Okay, any accruals and deferrals that relate to these transactions have to be reversed. Okay, so I'm going to teach you in a little while how you go about doing that. Okay, also payments of interest, okay, on debt, let's say on bonds payable, that's a very important outflow of cash. Okay, as well as everybody, dreads the payments of income taxes. Publicly traded corporations have to pay taxes. That's a major outflow of cash also. Okay, and then again, other expenditures. Let's say if a lawsuit is basically filed against them, and this corporation is unsuccessful, so they have to make a payment. Okay, that is going to be a cash outflow. All right, so what's going to happen is that you're going to learn how to translate the existing financial statements, how to translate them into the cash inflows and outflows of the corporation. Okay? All right, so. All right, and we're going to get back to the investing and financing section. Right now, what you're thinking of cash, and you're thinking of operating section only. Okay, now, again, this chapter is a lot, all right? Now, what's happened with the FASB? The FASB has been back and forth, okay, on basically how they were going to treat interest and dividends, okay? Where the receipt and payment of interest and dividends is going to appear on the statement of cash flows. Okay, and again, with the international, the IASB, there has been some discussion back and forth also. Okay, but what I want you to remember, and again, I'll repeat it over the course of the class, is that the final proclamation, okay, is that any dividends, again, these are dividends received from other corporations that this corporation has invested in. Any dividends and interest received, okay, is included in the operating section. Okay, so any dividends and interest received, okay, is going to be included in the operating section of the statement of cash flows. Okay, now question, is that going to be a source of cash for the corporation or a use of cash? Any interest and dividends received? Source, excellent, very good. Not Joshua, not use. This is the very good, Oscar. This is the corporation receiving dividends and interest from another corporation based on their investments. Okay, so again, you're putting your cash hat on. Okay, all you're thinking is cash, cash, cash. A corporation receives cash. Very good, Jeffrey. That's a source of cash. Okay, also. Okay, very good. Now. Furthermore, okay, and this is just the rule, okay, any interest paid, okay, and again, this is by the corporation whose statement of cash flows we're preparing, any interest paid, okay, to outside parties is also deducted in the operating section. Okay, and again, if a corporation pays, Joshua, if a corporation pays interest, okay, is that a cash inflow or a cash outflow? Anyone, if they pay interest to outside parties, is that a cash inflow, outflow? Very good, Lysander. Okay, so any dividends, very good, Kareem, Jeffrey, any interest and dividends received is going to be included on the statement of cash flows. It has to be in the operating section. Any interest paid by this corporation is deducted also in the operating section. Okay, now here's the stickler, and this is going to be for those of you who are here today, an extra 2 points, whatever, on the next midterm or quiz. Okay, any dividends, paid, okay, by the corporation, by the corporation to outside parties, and again, they're going to be paying dividends to their stockholders, right, their shareholders, that is going to be, okay, very good, an outflow. Any dividends paid by the corporation is an outflow, very good, is an outflow. But which section, anybody? Which section are dividends paid going to be presented in? Okay, and I'll give you a hint. It's not in the operating section. Okay, any dividends paid by the corporation, not investing. No, that would be a good. Any dividends paid by the corp. Yes, Joshua, financing. Okay, and that's just a tricky, very good, Oscar. Okay, any dividends paid by the corporation, okay, on their own stock must be included as a cash outflow in the financing section. Okay, and again, that's just a stipulation that FASB came up with. It was back and forth for a couple of years, okay, but this is now what the rule is. Okay, this is how these particular cash flows must be treated. Okay, and again, that would be a cash flow, right, Maria? Would be very good, a cash flow out of the corporation when they're when the corporation is paying dividends. And really the underlying logic of that, again, accountants are very logical. The underlying logic is because any dividends and interest received is included in the net income of the corporation. So, okay, we're going to include it in the operating section. Any interest paid by the corporation is also deducted on the income statement. Okay, but remember, when dividends are paid by the corporation, any dividends paid by the corporation on their own stock is not deductible on the income statement. Okay, so therefore, FASB has determined that since dividends paid are not deductible on the income statement, they must be treated as a cash outflow in the financing section. Okay, so that, and again, it'll come up again as we're going over our examples, but that's the logic, okay, behind this particular FASB guideline. All right. Okay. Okay, and ultimately, FASB agreed with that also, okay, with that delineation of how interest and dividends would be treated. All right, now, for purposes of preparing a financial statement, okay, or the statement of cash flows, again, what are we trying to do? We're trying to reconcile the amount of cash. Okay, cash is king for this statement. That's all you're going to think about. What's the effect of this particular transaction on cash? Okay, so what gets included in that category of cash. All right. So cash, obviously any cash deposit available for cash deposits that you have in the bank. Okay. They're going to be considered cash, right? That's going to be included in the cash balance. But in addition, okay, any highly liquid investments, remember we talked about those highly liquid marketable securities, okay, any highly liquid marketable securities that are going to mature within the next 90 days, in other words, they are going to become cash in the next 90 days, they are going to be included in the cash balance. Okay, and that makes sense because when we look at the cash balance on the balance sheet, okay, all of that, all of those investments would be included under the category of cash or available for sale marketable securities. Okay, so the available cash balances as well as the maturity value of any securities that are maturing within the next 90 days. Any long-term security investments, okay, long-term security investments are not included in the cash balance. Okay, and again, thinking back to the balance sheet, they wouldn't be included in that cash balance either. Okay, so again, if you have money market funds, commercial paper, treasury bills, those are all considered highly liquid marketable securities, and those amounts would be considered in the cash balance. Okay, now, okay, this is always a tricky question. Okay, if the corporation is transferring money between accounts. Okay, so we're always going to be given a trick question like this. When the corporation is transferring money between accounts, okay, when they're just basically transferring money between different accounts, that's always going to be a trick question. That is not a source or use of cash. Okay? Is not a source or use of cash. Okay, that's basically you're just taking cash and you're taking it out of one pocket and you're putting it into another pocket. Okay, as long as you're not taking that cash from your bank account, okay, from your, let's say, your money market account and investing in a long-term security. If you're just transferring it between one checking account to another checking account, that is not considered a source or use of cash. That would not appear on the statement of cash flows. Okay, so that's a little tricky question. All right, only if you're taking it and cash from what a checking account, which is available cash, and purchasing a long-term security, that would then appear on the statement of cash flows. Okay, so there's always some tricky questions that always come up, like with this financial statement. Okay. Again, here we're thinking operating section only. All right, now this. All right, this is where it starts to get a little tricky. So everybody stick with me. Okay, ask questions if you have. Okay, now we know if we look at the balance sheet, right? You all are sophisticated accountants now. If you look at the balance sheet and when you look at the income statement, you know that the balances in all of those accounts, okay, basically come from a general ledger, right? From a general ledger account. The balance in the cash account, you could tie it back to the ledger for the cash account. Okay, balance in the accounts payable, you just see the ending balance there, but you know you can get the details of that account. A separate general ledger account exists for every line item on the balance sheet and the income statement, right? Because that's how they're basically compiled. Okay, what happens with the statement of cash flows? The amounts that appear on the statement of cash flows do not tie directly into one general ledger account. Okay, the amounts on the statement of cash flows, you can't say, okay, the source of cash from operations. Okay, where does which general ledger account does that appear? It doesn't work that way. Okay, and why? Okay, Remember that when we were learning accounting and the general ledger accounts, okay, the general ledger accounts, okay, remember our general ledger accounts have basically include accruals and deferrals. All our general ledger accounts include accruals and deferrals. Okay, and those typically happen at month end and each and every month end. Okay, what's the problem there? Remember, accruals and deferrals do not involve cash. Okay, so when we're dealing with, all right, the statement of cash flows, we're going to have to reverse, okay, all of the accruals and deferrals that appear on the financial statements, okay, to get to what the actual change in cash is. Okay, so very different here, okay? There's no corresponding general ledger accounts for the statement of cash flows, but again, it always follows the same process. Okay, so we're going to go over all the steps to unaccrue those accounts, okay, and then you will become experts in it very shortly. Okay, so and now you're thinking, oh my goodness, how am I going to do this? Again, you're always going to mumble cash, cash, cash only, okay, when you're preparing the statement of cash flows. Okay, so what are we going to do? How do we prepare the operating statement, the operating section, and this is the toughest section on the statement of cash flows. How are we going to prepare it? Okay, what's going to happen is that you're always going to start, okay, with the income statement. Okay, so the income statement is the starting point for the operating section of the statement of cash flows. So what are we going to do? We're going to work our way down the income statement, okay, on a line-by-line basis, okay, for those transactions that affect operations. Okay, so the starting point for operations is always working your way through the income statement. Now, how are we going to unaccrue, okay, the balances on the income statement? Because remember, the income statement is prepared on an accrual basis. So how are we going to reverse that? There's certain accounts that appear on the income statement, and we're going to look at the changes in the related balance sheet accounts, okay, to figure out how those accounts are unaccrued. Okay, so remember earlier I told you that the statement of cash flows is going to test your knowledge and also really confirm your knowledge in the accounting process. This is how you're going to do it. Okay, start with the income statement and then tie in the changes and then tie in certain balance sheet accounts, okay, to unaccrue the balances that appear on the income statement, and that will give you the sources and uses of cash in the operating section. Okay, so start with the income statement, and then there's specific balance sheet accounts that you're going to look at to unaccrue those balances. Okay, always, that's the starting point. Okay, again, we're going to focus only on the direct method. You don't have to worry about the indirect method. Again, a multiple choice question on the midterm. How am I going to prepare my statement of cash flows? How am I going about what do I need? 3 pieces of information is required. Okay, so what do you need to prepare the statement of cash flows? The first thing is you're going to need the current year's income statement. Okay, you are going to need the income statement for the current year. Okay, especially for the operating section. Okay, what else do you need? You need comparative balance sheets. Okay, so you need 2 years of balance sheets. You need the balance sheets for the current year, okay, and you need the balance sheet for the last year. Okay, and what are you going to do? We are going to basically unaccrue the accounts that appear on the income statement based on the changes of certain balance sheet accounts. Okay, and because that's how we accrued it, really. Okay, we are going to reverse all of the accruals and all of the deferrals. And how do we do it? By starting with the income statement and then looking at the changes and reversing the changes in certain balance sheet accounts. Okay, that's the second piece of information. So 1 year's income statement, 2 years balance sheets. Okay, and then there's always an additional section. Okay, and that additional section is just called additional detailed information. Okay, you're always going to be given some supplemental information every time you do a statement of cash flows. Okay, and that's always going to just guide you because certain events are just too difficult to try to track. So again, really the majority of the statement of cash flows, you can really prepare it based on the additional information. Okay, so it just supports really what you're doing. Okay, so 3 pieces of information, good multiple choice question, cough, cough. Okay, and you can't do it without this. All right. Let's see. All right, so here we have the income statement. All right, this is a starting point again, and all you're thinking about now, you're forgetting about the other 2 sections. Here, you're just thinking operations. Only the operating section is the one that is prepared based on the income statement. Okay, so what are we going to do in the operating section? Okay, we are going to determine, again, always what all the sources of cash were, okay, and what all the uses of cash were in this section, okay, for this time period. Okay, so again, the statement of cash flows is always going to correspond, okay, with the same time period as the income statement. Okay, so once we have the income statement for this year, okay, now again, we're going to have to get the balance sheet for last year and this year as well, and also additional information. But this is going to be the starting point. All right. And again, we're going to look at all of the accounts. Okay. We are going to look on the income statement at all of the accounts that affect the ongoing operations. Okay. And again, we're going to unaccrue those accounts. All right. So which accounts are we going to unaccrue based on this income statement? Okay. Which of these accounts affects the day-to-day operations? Net sales, yes, absolutely. That's included in the day-to-day operations. Dividend revenue, yes, absolutely. That affects the day-to-day that comes out of the day-to-day operations. Interest revenue, okay, yes, that is basically from the day-to-day operations of the business. Gain on sales of plant assets, no, that's not really a day-to-day operation. When we talk about gains or sales or purchases of plant assets, we're going to see in a little while that affects the investing section. So we can ignore that information for right now. Okay. What else are we going to have to unaccrue? The cost of goods sold, yes, that's a part of the day-to-day operations. Operating expenses, absolutely, very good, Joshua. That affects the day-to-day operations. Interest expense, yep, we're going to have to unaccrue that one as well. Okay, but loss on sales of marketable securities, no. Okay, again, marketable securities are considered an investment. Okay, they don't really they don't really occur in the day-to-day operations. That is in the core business operations. Okay, so that piece of information we can ignore for the operating section. We'll come back to it when we prepare the investing section. Income tax expense, yes, that is going to be considered part of the day-to-day, incurred in the day-to-day operations. Okay, so here, looking at this particular income statement, I can tell you now, okay, that the revenues, okay, all the revenues that appear here, these are going to, and they have a little check mark next to it, those are going to be considered the sources of cash in the operating section. Okay, anything that basically appears here in the second half of the income statement, here when you have cash outflows or expenses, these are all going to have to be unaccrued, okay, and they're going to be considered uses of cash in the operating section. Okay, everybody with me so far? Okay, and again, very different from any other financial statement. I think it's fun, okay, because it really makes you figure out, okay, what does this mean? How does this information get here? How does it tie into the balance sheet? Okay, you really get to see how the financial statements are so interrelated. Okay, everybody good? Okay, again, cash, all you're mumbling to yourself is cash and operating section. Okay, now remember the second piece of information that we need, okay, is basically 2 years balance sheets. Okay, now do yourselves a favor. Okay, please do yourselves a favor. As soon as you see the balance sheet, realize that this is 2017, this is 2018. Okay, this is the prior year, this is the current year. Okay, so if I asked you, okay, what was the change in cash over the year, over 2018? Okay, what was the change in cash? Was it an increase in cash or a decrease in cash? And for how much? An increase. Excellent, Casey. Again, no. Lysander, I knew it was going to be you. No. Remember, we're going in this direction. Okay, so what happens here? Cash increased, okay, by 35,000. Okay, make sure that you're doing it in the right direction. Because if you said it was a decrease of 35,000, then you're going to basically, all of your analysis is going to be wrong. Okay, so make sure you're going in the right direction. And this is what we're going to do. Okay, what we're basically trying to tie into in the statement of cash flows, see how cash increased by 35,000. What the statement of cash flows is going to basically tell us, it's going to tell us where that cash increase of $35,000 came from. Okay, where is that cash increase of 35,000? Where is it generated? Is it generated in the operating section? Is it generated in the investing section? Or was it generated from the financing section? Okay, and again, you're going to have some back and forth in each of these three sections. Okay, but remember, over the long run, a corporation wants to see most of its cash being generated in the operating section. Okay, so again, and that's what we're going to tie into. Okay, because you really can't figure this out from any other financial statement. Okay, there was an increase in cash for this year of 35,000. Okay, where did that cash come from? Okay, you can't tell, right? That's what the statement of cash flows is going to basically tell us. Okay, so again, that's the end point. Okay, when we look at all of our sources of cash in the operating section, in the investing section, and in the financing section, we're going to see that the total change in each of those three sections basically is going to equal that $35,000. Okay. All right. So that's the second piece of information that we're going to need. Okay. 2 years balance sheets. Okay. And then remember that third piece of information I mentioned, the additional information. Again, this is pivotal. This supports all of your calculations. Okay, so again, to facilitate this, the preparation of the statement of cash flows, there's always going to be support information that is provided. Okay, remember, you're always immediately statement of cash flows. You're going to think OIF, or in operating, investing, financing, the three required sections in that order. Okay, and what is that additional information going to provide? Look how much fun this is. Okay, all right. So now we have this is for the operating section. This is the support information, and this is all we're focusing on now. Okay, now the first thing we see here, number one, all right, is that accounts receivable increased by $30,000. Okay, now, but wait a minute, I want to confirm that. Okay, so where do I go? I'll go to the balance sheet. Okay, and I see here, okay, that's true. My accounts receivable increased by $30,000, okay, or the corporation's accounts receivable increased by $30,000. Now, okay, and again, I'm going to spend some time going over the details. This will become second nature to you, all right? When in doubt, okay, you're going to remind yourself that for this statement, you're thinking cash, cash, okay? But now think about it. When a corporation, okay, records an increase in an accounts receivable, okay, what is that journal entry when accounts receivable are increased? Okay, typically what's going to happen is that accounts receivable will be debited. Okay, and then what else is the second part of that journal entry? Typically sales, right, is going to be credited. Okay, now accounts receivable debited increases the accounts receivable. Sales credited increases the amount of the sales. Now, remember, we're thinking only cash here, right? For this statement, we're thinking only cash, all right? So if accounts receivable increased over the course of this year, okay, what effect did that have on cash? Okay, how much, how are we going to tie the increase in the accounts receivable to the cash received from sales? Okay, because that's going to be our first line, okay, our first source of cash and the most important source of cash. Okay, how do we tie it into the source of cash? SOURCE, source of cash. All right, we know that when accounts receivable increased, was there an increase in cash? Okay, when we have an accounts receivable increase of $30,000, no, excellent, Lysander. Cash did not increase. Okay, so what do you have to do? What has to basically happen? And this is on the first line of the operating section. Okay, basically what has to happen is that there has to be a reversal, okay, of the increase in accounts receivable. Okay, so again, I just wanted to show you that here. Let's go back to the income statement. Okay, so this is the first thing. Okay, this is the first document that you are going to look at when you're looking at the operating section. Okay, we are going to go through on a line-by-line basis, okay, for all of those accounts that affect day-to-day operations. Okay, so let's start here. Let's start with net sales. Okay, net sales is the first line of the income statement, $900,000. Okay, so very nice. We know the net sales for this corporation for this year equaled $900,000. Okay, but what else do we know? We also know that accounts receivable increased, okay, by $30,000. Okay, and now we just said, since accounts payable increased, what does that mean? Certain sales for $30,000, that is total sales of $30,000, was recorded on the income statement, but the cash has not yet been received. Okay, so what has to happen? The first calculation you're going to do okay, that ties into the statement of cash flows. The first thing you're going to do is look at the cash received from customers. Okay, and again, we know that that line, okay, we're starting always with the income statement. Okay, we know that, we know that cash received from customers is basically recorded as sales dollars, right? Okay, and now I want you to think of this, follow through with me, okay? And it's always the same, okay? So once you understand it, it's the same for any statement of cash flows. If accounts receivable increased over the course of this year, okay, what does that mean? That means basically credit sales, okay? Credit sales for this year exceeded the amount of the collections of cash, okay? If accounts receivable increased over the course of this year, that means that credit sales, the total amount of credit sales, was greater than the amount of cash that was received this year. Okay, so what do you have to do if accounts receivable increased? You are going to deduct the increase from the accounts receivable from sales, okay, to arrive at the cash received from sales for the year. Okay, so again, very important you go in the right direction on the balance sheet. First thing you're going to do is take the sales figure from the income statement. Then you're going to look at accounts receivable, okay, on the balance sheet. If accounts receivable increased over the year, you're going to subtract that increase from the sales figure to arrive at your cash received from customers. Okay, but you know the opposite could happen. If accounts receivable decreased, okay, if accounts receivable decreased over the course of the year, what does that mean? That means that basically collections of the accounts receivable, okay, were greater than the credit sales. Okay, so if the collections of if the accounts receivable decreased, that means the amount of cash that you received this year was greater than the credit sales for this year. Okay, so what are you going to do when accounts receivable decreases? You're going to add the decrease in the accounts receivable to the net sales figure on the income statement. Okay? Again, the first time it's kind of like, uh-oh, I don't know if I'm going to get this. It's the same formula all the time. So again, in the operating section, right, we're trying to tie into how much cash was received from customers. Okay, the problem is there's no general ledger account that ties into cash received from customers. Okay, and remember, all we're interested in this financial statement is the cash sources, cash uses. Okay, so here, what are we going to do? How do we arrive at the cash received from customers? We're going to look at the net sales figure, and remember, that is the top line always on the income statement. Okay, then we're going to look at the balance sheet. Okay, so we are unaccruing the income statement based on the changes in certain balance sheet accounts. Okay, now, if accounts receivable decreased over this year, okay, any decrease in accounts receivable is going to be added to the net sales. Okay, and why? What does that mean? That means that in addition to the sales amount this year, if accounts receivable decreased, that means that in addition to the credit sales for this year, okay, some of last year's credit sales, the cash was also received this year. Okay, then see the flip side. Okay, if we're going to start with the net sales figure on the income statement, and then look at the balance sheet, the related balance sheet accounts. If accounts receivable increased this year, okay, if accounts, and that's what we have here in our example. If accounts receivable increased over the course of this year, okay, that means we recorded sales for this year that we haven't received the cash for. Okay, again, we're trying to tie into the cash source number here. So any increase in accounts receivable is going to be subtracted from the net sales figure. Okay, so again, it's one or the other. You're looking at the change in the accounts receivable account, okay, and that is going to determine if you're going to add or subtract the change in the accounts receivable. Okay, so let's tie this into our financial statements. Okay, net sales. Okay, again, that's on the accrual basis. That's our problem. Okay, the income statement is on an accrual basis. We look at the first line of the income statement, and it tells us we had $900,000 in sales this year. Okay, how much of that though was cash? Okay, cash is king here. What do? We look at the balance sheet account, and this is all we're going to do. Okay, for the operating section, we're looking at an income statement account, and we are unaccruing that income statement account based on changes in the balance sheet accounts. Okay, so here we saw that if we looked at the balance sheet, we saw there was an increase in accounts receivable. If there is an increase in accounts receivable, that means sales were made this year. We haven't yet received the cash. So the amount of the increase in accounts receivable is subtracted from sales. And how much cash did this company receive from their customers? Okay, from sales for this year, $870,000. Okay, and that is going to be our first source of cash in the operating section always. Okay, that is the formula for unaccruing sales. Okay, at this point, if it's easier for you just to memorize it, memorize it. But again, it's always better to try to understand the logic behind it. Okay, questions? All right, again, unlike any other financial statement, okay, so it's always, yeah, exactly, bring it home, Joshua, the change, if accounts receivable increases, you always subtract it, yes, from sales. And if, if accounts receivable increases, you're always going to subtract the increase, yes. Okay, if accounts receivable decreases, you're always going to add that. That's exactly right. Always. Okay, so just get that out of the way. And again, what are you doing? You're unaccruing the sales account based on changes in the related balance sheet account. Okay, good. And again, we're just going to work our way down the income statement, okay, in the operating section. Okay, so the next thing we're going to do, let's look at the next line, right? We finished the first line, which is sales. What is the next line on the income statement? It is going to be, maybe it's easier if I do this. The next line on the income statement is going to be interest revenue and dividend revenue. Okay. We're going to do a lot of examples, Joshua. I just want to work through it here. Okay, let's work through the logic, and then we're going to go many examples, okay, just to bring it home. Okay. All right, so here. All right, now, the next line, okay, and just so that you see I'm not making this up, remember that in the operating section, you're just working your way down the income statement. Okay, so now we've taken care of net sales. Now we look at the next line item that appears on the income statement, dividend revenue and interest revenue. Okay, what's the problem with these revenue accounts? They could and they may include some accruals. Okay, and if there are accruals in any of these accounts, remember that means that these aren't the actual cash increases. Okay, so here, and again, you look at the two financial statements, the current year's income statement, the last 2 years' balance sheet. Okay, and now we're going to look at the additional information section. Okay, so here, you're told here in the additional information section that dividend revenue is recorded on a cash basis. Okay, so since the dividend revenue is on a cash basis, there's no accruals. That means that $3,000, the $3,000 that we received, that the corporation received from dividends, okay, that is $3,000. That is the next source of cash in the operating section. Okay, that $3,000 from dividend revenue, cash basis, we don't have to unaccrue it. Okay, that's the next line, $3,000 in dividend revenue. Okay, now though, let's look at the interest revenue, which is the next line on the income statement. Interest revenue is recorded on an accrual basis. Okay, so remember, and again here, Joshua, this will help you. Just like we unaccrued sales, right? The sales figure. Now we are going to unaccrue the interest revenue. Okay, so what are we going to do? We're going to look at the interest revenue account. Okay, and here I just like to go back just so you could see what exactly I'm doing. Again, we're just unaccruing the income statement, based on changes on the balance sheet. Okay, so now we figure out net sales, we figure out dividend revenue, we've unaccrued those amounts. Now we have interest revenue. All right, so the starting point for interest revenue is the $6,000 that we see here on the income statement. Okay, now what are we going to do? We have to look at the related balance sheet account for interest revenue. Okay, what account is that going to be? That's going to be interest receivable, accrued interest receivable. Okay, now, okay, what happened to interest receivable over the course of this year? Okay, what happened to interest receivable over the course of this year? Did it increase? Excellent, Rachel. It decreased, Daniel. Excellent. Since interest receivable basically decreased, how does interest receivable, and again, with this particular financial statement, when you're preparing it, always go back to the journal entry. It really helps. This is why I was saying earlier, it really tests your knowledge of the accounting process. What happens when interest receivable is decreased? Again, that journal entry is going to be a debit to cash and a credit to interest receivable. Interest receivable. Okay, so what does this mean? It means a portion of this interest receivable was liquidated. Okay, and how much of the interest receivable was actually liquidated? We know $1,000, right? We saw $1,000 decrease in accounts receivable. So what does this mean? This means that in addition, okay, to the $6,000 of interest revenue that was recorded this year, in addition, an additional $1,000 of cash was received through the fact that this interest receivable was reversed. Okay. So what does that look like? And again, it's always the same. The going through it the first time is the hardest. Okay, but now here, so Allison Corporation, interest and dividends received. Okay, we know we don't have to worry about unaccruing dividends. The dividends are on a cash basis. They stay the same, $3,000. Okay, so Joshua, so the $1,000, that's exactly right. By subtracting the $3,000 balance in the interest receivable at the beginning of the year and subtracting it by the balance in that interest receivable at year end. Yes, exactly right. Okay, so just like we unaccrued the sales account, we are now going to unaccrue the interest revenue account. All right, so the interest revenue account, remember on the income statement, that started out with a balance of $6,000, right? Okay, now we're going to look at the related balance sheet account, and on the balance sheet, what happened? We know that the interest revenue account decreased by $1,000. Okay, what do we do with a decrease of $1,000? We add that amount to the $6,000. So the $6,000 plus the $1,000, okay? Remember, that accrual of interest was recorded in the previous year, okay? But the cash was received this year. Remember, we have blinders on and we're thinking cash, cash, cash only. Okay, so here, interest revenue, $6,000. Remember, that's on an accrual basis on the income statement. Okay, we look at the related account on the balance sheet, which is always the same account, interest receivable. Okay, remember, that's the balance sheet account. Since the interest receivable decreased, what do we do with that decrease? We add the decrease. Okay, so here we add the decrease. So what is the amount of cash received from interest for this year? It equals $7,000. Okay? Everybody good? And again, through repetition and through going over it, it's always the same. Okay, every single statement of cash flows is going to be prepared the same way. Okay? All right, so here, in terms of sources of cash, okay, from operations, in addition to cash received from customers, what were some other sources of cash for the corporation? Cash received from interest and cash received from dividends. And how much cash did it provide? $10,000. Okay, always the same calculation. Different amounts, the same calculation. All right, so now let me go back to the income statement. Now we've completed all the sources of cash, okay, in the operating section. Okay, and again, the other sections are easier. Now we've finished, okay, this was a source of cash, this was a source of cash, this was a source of cash. We've looked at all the sources. Again, this is not included in the operating section. It's in the investing section. Now what do we have to look at? Now we have to look at what the uses of cash were, okay, in the operating section. Okay, and now the first line that we are going to look at is here, the cost of goods sold. Okay, so now we're going to accrue cost of goods sold. Okay, and again, hang on. All right, this one's a little bit more complicated. But again, it always is the same formula. And again, once you get this formula, it's just going to be so much fun to do these to prepare these financial statements. You could become an expert, who knows, right? This will be your thing in your career. All right, so now again, what are we thinking about? We know we're thinking about the operating section only. I can't emphasize that enough because it's so important. And we know that we basically have a hat on our head that is saying all we are thinking about is cash, okay? But what's wrong? The next line on the income statement is basically cost of goods sold. So we have to try, okay, to unaccrue the cost of goods sold, all right? How are we going to do that? And what does that actually mean, okay? When we ultimately unaccrue the cost of goods sold, what are we going to do? We're going to figure out, and again, this is a use of cash, okay? This is going to be a use of cash, and not a source. This is our first use of cash. It's usually the biggest use of cash you can imagine, especially for a retailer, etc. Okay, this is a use of cash. We're trying to figure out the amount of cash. Cash is king. The amount of cash that was paid for purchases. Okay, so what is our starting point going to be? We're going to look at the cost of goods sold again on the income statement. Yes, exactly. We've gone through the sources of cash, those first three lines, okay, which were sales, interest revenue, and dividend revenue, and now we're looking at the uses. Exactly right. Okay, What's the first line when we're looking at the uses? We're going to start with the cost of goods sold on the income statement. Okay. What's the related account on the balance sheet that ties into cost of goods sold? Now, cost of goods sold, what does it represent? Okay. When we look at the account, again, you've learned all about this in Accounting 101, a little bit in Accounting 102. What does the cost of goods sold represent? Anyone? Again, it's an income statement item. Okay. What does it represent? It's an expense. Very good, Oscar. And what type of expense is it? It's an expense. It's the amount of money that the corporation paid, okay, for the goods, for the inventory that it sold, okay, to their customers. That's how much the inventory that was sold to their customers, that's what the cost was, okay? But in addition, we know that if you're a retailer, okay, if you go into Target, you know that Target is never just going to sell like all of their goods at any particular point in time. You know that they also have inventory, right, which must be maintained on hand at any point in time. So again, we're trying to figure out the cash payments for purchases. We start with the cost of goods sold on the income statement. All right, and now we're going to look at the changes into, okay, this is a little bit more complicated because we're going to look at the changes into balance sheet accounts. Okay, the first account we're going to look at is on the balance sheet. Okay, now the way we're going to consider it is that if inventory increased, okay, if the inventory account on the balance sheet increased, what does that mean? That means in addition to the goods that were sold, okay, the corporation also paid additional cash for inventory that it has on hand. Okay, and that inventory is still on the shelves, and that's why it's included in the inventory account. Okay, however, if the inventory account decreased, okay, if there was a decrease in the inventory account, that means that some of the inventory that the corporation had on hand at the beginning of the year, some of that inventory was sold this year. Okay? So, and since some of the inventory, in addition to everything that was sold, a portion of the goods that the corporation had on hand at the beginning of the year, a portion of that inventory was sold this year. Okay, so if there's a decrease in the inventory account over this year, that decrease is going to be subtracted from the cost of goods sold. Okay, because that inventory wasn't purchased this year, that inventory was purchased last year. Because it was sitting in the inventory account at the beginning of this year. Okay, so that's the first step, all right? And this formula has 2 steps. Okay, because you know that if inventory increased, you know you purchased that inventory, right? The corporation purchased that additional inventory that has not sold yet. Okay, but okay, how do we know how that inventory increase affected cash? Remember, all we're thinking of when we're doing this financial statement, all we're doing is thinking about the effect on cash. So the second step, okay, in unaccruing the cost of goods sold, we have to look at the changes in accounts payable also. Okay, and now I want you to think of it. How does accounts payable decrease? Okay, accounts payable decreases when a corporation pays off their accounts payable. Okay, so here let's look at what the journal, and again, always look at the journal entry, okay, in life, okay? Whenever you're in doubt, look at the journal entry. So if there's a decrease in accounts payable, all right, what's the journal entry for that? Okay, what's going to happen, we know, is that accounts payable is going to have to be debited, right? That's how accounts payable is decreased. And then what is the credit to? Okay, let's go back to some of our basic accounting. Cash, excellent, Lysander. Cash. Okay, so when we decrease accounts payable, it is debited and then cash is credited. Remember, this is a further use of cash, right? If we're reducing cash here, if accounts payable decreases, this is a further use in cash, okay? We're trying to tie into the amount of the cash payments for purchases, okay? So if accounts payable decrease, that means that in addition to the cost of goods sold, we've also, the corporation also used cash in order to pay off some of its existing accounts payable. Okay, so that decrease in accounts payable is going to be added, okay, to the cost of goods sold to figure out cash used for purchases. Okay, now let's take the flip side. Okay, let's say here now that accounts payable increased. Okay, if accounts payable increased, okay, go back to that journal entry. Increase in accounts payable. What is the journal entry when accounts payable increases? Okay, you know that here, since we're talking about purchases, we are going to debit the inventory account, right? And then has the corporation paid for this inventory? No. Okay, some of the inventory they received has not yet been paid for with cash. So what is the credit going to be to? The credit is going to be to accounts payable. Okay, so if the accounts payable account increases, okay, over the course of the year, that means that cash has not yet been paid for that inventory. So that increase in accounts payable is going to be subtracted, okay, from the cost of goods sold to figure out the amount. Again, the underwriting theme we're trying to come up with here is how much cash was paid, okay, for the purchases of inventory for this year. Okay, so for cash paid for purchases, you have to walk through these two steps. You start with the income statement account of cost of goods sold, and then you look always at the change in the inventory account and in the accounts payable. Okay, and you track these changes this way. Only way you can do it, I promise you, it will become second nature. Okay, so let's walk through this. Cost of goods sold, again, that's the amount on the income statement. Why can't we just use the cost of goods sold? Because we know it has been accrued. Okay, so what are we going to do here? Start with 500,000. Then what are we going to do? We're looking at the inventory account on the balance sheet. What happens to the inventory account on the balance sheet? We see that inventory increases by $10,000. Okay, what does that mean? That means in addition to the goods that the corporation sold this year and is included in cost of goods sold, in addition, they purchased an additional $10,000 in inventory. Okay, and they just haven't sold it yet. Okay, but it's sitting in that asset account of inventory. Okay, now what else? What's the second step? Okay, we get a subtotal there for net purchases on the accrual basis, but okay, it could mean, okay, that some of that inventory was purchased this year, but it has not yet been paid for. Okay, it's going to be paid for in the next year, in the next period. Okay, so what's the second account we have to look at the balance sheet? We basically have to look at the accounts payable on the balance sheet. Okay, what happened to accounts payable for this year? We see that accounts payable also increased for this year. Okay, meaning that some inventory was purchased this year, but it has not yet been paid for. How much specifically? The amount of the increase in accounts payable, which equals $15,000. So what are you going to do? I'm sorry. So here, what happened to, yes, accounts payable increased, Okay, so what do you have to do? That increase in accounts payable, you're going to subtract that increase in accounts payable. You're going to subtract it, okay, from the cost of goods sold. Why? Because this inventory has not yet been paid for. Okay, this inventory purchase did not affect cash. Okay, so when we look at the cost of goods sold, we look at the change in inventory, we look at the change in accounts payable. Again, these are the two steps. Same two steps are always going to happen. What does that result in? Now we can see from this what the cash payments for merchandise was. Okay, so 500,000, which was the cost of goods sold. Remember, that's the starting point. We are going to add the $10,000 in inventory, subtract the $15,000 increase in accounts payable. So what was the amount of cash paid for inventory this year, or paid for purchases this year? $495,000. Okay. Again, how do you know I'm not making this up? We're going to try look at track the change in inventory and accounts payable to the financial statements. Okay, again, we are unaccruing the income statement. And it's always the same steps. Okay, you will become, so here's the income statement. Okay, so here we're trying to tie into the cost of goods sold. This is the next line that we're looking at. Okay, so we're gonna unaccrue cost of goods sold. Again, which accounts you have to look at? We have to look first at the inventory account. Okay, so what happened to inventory over the course of this year? Inventory increased by $10,000. Okay, so that means the corporation had additional purchases of $10,000 for this year. Okay, now let's look at accounts payable. Okay, because that's how, if some of those goods were bought on credit, let's see how much of the inventory and purchases for this year were paid for in cash. Okay, our accounts payable at the beginning of the year was $61,000. Okay, but what happened to our accounts payable? Our accounts payable increased by $15,000. Okay, when accounts payable increases, that means that some of those goods have not yet been paid for. Okay, so those two line items, that is what we are looking at. Okay, when we are unaccruing cost of goods sold, those are the two accounts that we're going to be looking at to unaccrue them. Okay, and that is how we prepare this particular section. Okay, everybody good? Okay, always start here with the income statement, cost of goods sold, and then you look at the changes in inventory and accounts payable to unaccrue the cost of goods sold. Okay, second nature, from now on, whenever we do any of these equations, any of these financial statements, you'll be able to do it because it's the same thing. Okay. All right, let's look at the next line. Again, we are working our way down the income statement. So what do we see next appearing on the income statement? We are looking at the amount of cash payments for expenses. We got cost of goods sold, the big expense. We got that out of the way. Okay. Remember now, what are we doing? On the statement of cash flows, we are unaccruing. Our major purpose is to unaccrue, okay, our financial statements. All right. Now, we know when we're converting certain accrual basis accounting to cash basis, okay, we know that certain expenses that appear on the income statement, we know that some of these expenses do not ever affect cash, right? The cash transaction happened in an earlier period, okay? But again, when we are amortizing an asset, when we're depreciating a long-term asset, when we're amortizing an intangible asset or a bond discount, okay, and also unfunding post-retirement benefits. We know that all of these expenses, okay, they may appear on the income statement, okay, but remember, okay, we're only dealing with cash. Cash is all we are interested in for the statement of cash flows. Cash, cash, cash. Okay, so we know if we have non-cash expenses, all of these non-cash expenses cannot be considered. Okay, they cannot be included on the statement of cash flows. Okay, very important point because of the fact that they don't involve cash. Okay, now again, what are we continuing? We're still looking at the operating section, and we're still looking at the uses of cash in the operating section. Okay, so what happens here? We know that if we have any type of non-cash expense, it must be ignored. It's not going to be converted to a cash basis. It can't be. Okay, that's the first thing to look for. Okay, after cost of goods sold. Okay, so and again, now what do we have to do? Okay, gets a little bit tricky. Again, the uses of cash, the expenses are a little bit trickier. All right, but again, once you understand how to do them, expenses are always treated the same way. Okay, now a second type of timing difference. Okay, and again, remember accruals and deferrals. Okay, the reason that we have to prepare accruals and deferrals. Accruals and deferrals are basically the result of timing differences. Okay, accruals and deferrals are because of timing difference. An event has been recorded, okay, on the financial statements. All right, an expense has been incurred during the current time period. Okay, but it could be like in the event of unearned revenue that the cash really was received in an earlier period. Okay, we're booking the expense during the current period, but it could be that there was a prepayment, okay, and the cash was received in a previous period. Okay, it could be that an expense is recorded in the current period, and the cash is also recorded in the current period. Okay, that one is not a problem, but remember that a lot of time when you have accruals of expenses, what happens is that the expenses accrued in the current period, but the cash is not going to be paid until a future period. Okay, so when we're dealing with any type of expenses and we're dealing with deferrals and accruals, we also have to consider when the cash was affected, because we're still here dealing with cash. All right. So what I'm going to do, I know you've absorbed a lot this class. Okay. What we're going to do, please, for those of you who haven't read this chapter, please read this chapter for next time, right, and start some of the exercises. So this weekend you have your work cut out for you, and we are going to continue with the statement of cash flows. Okay, for this particular financial statement when we meet again on Tuesday. Okay, and again, this is a tough chapter. This is the one we'll have the quiz on. Okay, but again, once you get it, once you get the statement of cash flows, you'll know it. You'll understand every statement of cash flows. Okay, so any questions before we adjourn? Okay, if not, everybody stay healthy, stay happy. You're welcome, guys. Wash your hands, wear masks, and vote ahead. Vote early if you can. Okay, you're welcome, guys. Okay, again, we're more than halfway through. You too, Kristen. Thank you, Christian, Lysander. Remember, we're more than halfway through. This is the time to dig in, not give up, okay? You're welcome, Shamia. Keep up the good work, everybody. And have a good weekend, too.